All right, welcome back to another podcast. I'm Josh Kozis. I'm joined with Michael Harvey. Thanks for coming in.
No worries, Josh. Good to see you again.
Thought with the time of year, we're approaching the end of March, and that's the FBT year comes to mind, and thought good opportunity to talk a little bit about salary packaging, how that relates to vehicles as well as superannuation. There's a lot of different arrangements that people can make with their employer, so I thought we'd dive into that today. What we might start with is, I guess, just finding out a little bit more about vehicles. So that tends to be the common one I get with clients is, hey Josh, I've had a representative from a particular company say something about being able to buy a new vehicle and also save some tax. Is that good for me? What does it all mean? So I thought best to talk to an accountant directly and find out more about it.
Yep. Thanks, Josh. So vehicles are the most popular item under the umbrella of salary packaging. So salary packaging is offered by an increasing number of employers, which allows certain items of expenditure to be packaged under your salary arrangement. Mm-hmm. So if you're on $80,000 a year, say, as your gross wage, then your portion of that wage can be put into a packaging account. An important thing to mention here is there is a distinction between some employers, typically in the not-for-profit space, the government space, have an additional benefit compared to the private market. So the packaging and private market, there's fringe benefits tax applies from $1, and in the not-for-profit charity government market employers, there's FBT exemptions up to I think it's 30,000, the total amount after allowing for fringe benefits tax. It works out about $18,000 of actually pre-tax dollars that if you're working for a charity and they offer it, then you can put a whole range of things in addition to vehicles into a salary packaging account.
Yeah, and so what types of things are those? So an example that comes to mind is sometimes I get people working in the public health or maybe for a church, and they'll come and say, I'm making tax deductible contributions into my mortgage, or I've got a meal allowance, or an opportunity for a car. So what are some other types of things people can package?
Yeah, so normally I see people packaging up their mortgage. So effectively it gives people a pay rise. So if you're on 30 cents in the dollar as a marginal tax rate, then effectively if you're paying out of pre-tax dollars, you're getting a 30% bonus on that element.
Yeah, or saving tax and reducing loan interest as well, so double benefit there.
Yeah, so if your charity, your church offer that option, then it's certainly worth exploring. Normally they have like an outsourced provider that can do the numbers for that scenario, and then that provider, along with the employer, has certain rules and components about how you can break that up. So most times I see mortgages being able to bundle it up into the packaging. Sometimes people have a meal card or entertainment card. We were discussing before, the principle still applies. If you don't need that card, don't get it just because you can get a fringe benefits benefit. If you're not a person that eats out a lot and meal cards, then otherwise it creates a spending habit that maybe you don't need. So, but yeah, it's worth chatting to your employer if you're in that not-for-profit space, government, if they offer the not-for-profit or the exempt fringe benefits cap. So that's one thing to explore. And then in the private market, as well as the not-for-profit market, this is across the board, vehicle packaging is a very popular item, and the most popular is novated leases. So the basis of a novated lease, essentially what it means is that it's a three-way lease agreement between the finance company, yourself as an employee, and your employer. The employer is a party to that agreement in that they have to basically rearrange your payroll settings to take out a certain amount, pre-tax and post-tax, whatever's advised by the packaging company normally involved with that scenario.
So really when the employer says, yep, I'm happy to take that on, all they're really agreeing to is the same way that they already allocate putting your pay into a certain bank account and putting your super into a particular fund. They're going, there's this other category that I'm now going to contribute funds in pre-tax to fund a vehicle or whatever it might be.
So in practical terms, MDH County in the last 18 months has offered salary packaging to our employees. The predominant one is for people looking for a car, and this is a car for private purposes. So we don't, being an accounting firm, we don't need to have company cars compared to other businesses. And so this allowed the employee to liaise directly with the packaging company, crunch the numbers for their individual scenario. And I was pleasantly surprised that most, or had, I think the first 2 or 3 employees, most times the numbers crunched that they were better after tax. Bearing in mind it was a car that they were planning to buy, so
yes.
the decision was made first on buying it. Would like to buy a car, and then the second decision is how can I do that most tax effectively through my employer through packaging. So don't just go and buy a car because you can
that's
get a tax
common
benefit.
And I've certainly had friends in the past, particularly before I got into financial planning and started to understand a little bit more, where it was a bit of a buzzword where people talk about salary packaging, and it was very much, hey, I've heard this way that I can get a brand new car and I've never had that before, so I get all the bells and whistles, and somehow it also saves some tax as well. So off they go and get themselves into agreements. But to your point earlier, it's if you're already looking at say a $15,000 car is all you needed, well, looking at a $55,000 brand new car just to save tax might not make sense, because I guess another word people might have heard as salary packaging is salary sacrifice. The key being that you are sacrificing a portion of your salary, which goes towards paying groceries and loan repayments. And so spending $1 in the hopes that you'll claim back 32 cents if that's your tax rate might not make a lot of sense. So
so say to my business clients, if they're in a company, it's 25 cents the dollar tax rate. You spend $1 to save 25 cents. You've still got to fund the 75 cents. If you don't need that 75 cents to be spent, don't spend it. So that principle still applies. So so assuming you want to buy a car, salary packaging via novated lease can work for certain employee arrangements in the private sector. Private and public in this example, in this scenario. There is, I was just reading an article yesterday talking about electric vehicles, and people may or may not be aware there's an exemption for electric vehicles from fringe benefits tax. So just to wind the clock back a bit, fringe benefits tax came in, late 80s, I think it was a Keating initiative. Basically it taxes the employer of any non-cash benefits or any additional benefits above the salary that people are paid as part of their employment arrangement. So it just stops people sort of, back in the 80s, people were paying for their school fees and stuff like that through their employer.
Well, that's the key. It's that wording, isn't it? It's fringe benefits. We all know that salary is a direct benefit. That's what most people think about. But what else are you getting benefit from on the fringes of your employment? And sometimes it's throwing in a vehicle or a phone or something. The government's saying, well, in lieu of the income that you would have ordinarily received to pay for that item, they want to make sure they're still charging tax on it. And
the fringe benefits tax rate is quite high. It's at 47 cents effectively, which is the top marginal tax rate. So over the journey, it's sort of like if you're on a lower taxable income, it didn't sort of make sense to pay fringe benefits tax. Those examples I've had through MDH employees as well as other clients more recently. The modelling now would allow that, and especially in the electric vehicle space. So the article I was reading was that because basically fringe benefits tax exemption, so no fringe benefits tax payable by the employer, which normally gets passed through to the employee, on electric vehicles and plug-in hybrids. The exemption for plug-in hybrids ends 31st of March 2025, so in a couple of weeks' time. So the article is talking about a bit of a rush electric vehicles order to get in there, because people prefer probably the plug-in hybrid models because of the access to refuel, recharging stations and stuff like that. So at this stage, the government haven't indicated whether they're going to stop the fringe benefits tax exemption for full EVs, so that's continuing to the best of our knowledge, but the plug-in hybrids finishes at the end of March. What that meant was that people could salary package electric vehicle or plug-in hybrid and get a really great tax benefit. The article quoted, and I haven't no reason to dispute it, on roughly a $60,000 electric vehicle, you could save up to 12 grand a year from a tax position. Bear in mind, once again, if you don't have a $60,000 vehicle, then the tax saving is only relative to what you're going to do anyway.
Yeah, or if you're already living week to week, I suppose,
Yeah.
because you're also needing to contribute some after-tax funds potentially.
Yep.
So
There's been a really strong uptake in novated leases. I think the article sort of talked about 1 in 2 electric vehicle purchases in the last 6 months has been for an electric vehicle because of this exemption. Bear in mind it can apply to salary packaging can apply across the board, so petrol vehicles can still be salary packaged, just as a fringe benefits tax payable under your packaging calculation. So just to re-emphasise, I suppose, that the novated lease and some of the tricks and traps. So because it's a 3-way agreement, effectively the employee guarantees that agreement. So if you lost your job or transferred employment, then the default is back to the employee on a personal level. So effectively you're still liable for that monthly payment and balloon payment under the lease contract.
So in my words, so if you were someone who's potentially looking at a new employer over the next 12 months and you've got 3 years left on your car lease, important that when you speak to your new employer that you're actually able to get that understanding or agreement from them that they're happy to continue that arrangement.
Yeah.
So I'm not sure how common it is that might happen, but in the case that an employer said, no, we don't want to do that because maybe it's a small business, they don't want the admin or the paperwork, what might happen in that scenario?
So that scenario it falls back on the employee, that they've got a liability to effectively fund from their after-tax dollars the monthly repayment on that lease, on that finance arrangement.
So really important when they're looking at a vehicle, not just seeing the brand new car and thinking about that heated seats that they've never had, but also saying, it's not just about the tax benefits. Am I going to be in the same position over the next couple of years and trying to project forward? It doesn't necessarily stop you moving employers, but just a consideration that you need to...
Great point, Josh. If you are moving employers and you've got a novated lease, they are transportable on the blessing of the new employer. They need to become a party to that to be able to package it the way you had it set up previously.
Yeah.
So it's not a handbrake, just I suppose tricks and traps to watch when you do have a novated lease. When you go into novated lease as well, just watch a few things. So you have, normally I would see a fully maintained package amount versus a non-maintained. What that meant is that you can package up all your running costs, like your tyres and your repairs and your services, into one bundle and just pay one monthly fee. And other people elect, or sometimes the offer is it just covers your finance charges, and then you just pay for your running costs like your fuel and everything else out of your own pocket. So it's a matter of crunching those numbers and see if it works, and just watch for any loadings. Like sometimes the discounts are real under a packaging arrangement through these packaging companies, and sometimes they're a little bit like probably get a better deal elsewhere. So insurance is a classic example. You could package up your insurance and they might have a group policy, something like that, through their packaging networks. But still, buyer beware, still check that against what you could buy in the open market to make sure it's still reasonable.
Well, that's the thing, when you're looking at a vehicle, getting it from down the street versus another dealership can even in fact influence the car price. You've got the different packaging providers have various fees that they charge as well, so keeping that in mind. Some questions that come to mind for me though are, I guess when somebody's considering purchasing a salary packaging arrangement, what are some things that they should be thinking about? Is it purely about tax savings? Is it purely about the purchase of something? Should they be thinking about how it affects their after-tax income as well?
Yeah, I mean, it's tax beneficial under a packaging arrangement, but you still got your hand in your pocket for an amount each month.
Yep.
Especially if you're at that point in time, you might be looking at either refinancing your home or taking out your first home mortgage, then it is a liability that sits on your personal balance sheet, to use an accounting term. That financiers for a home would say, you've got that liability, even though you may think the employer has got that responsibility. As I said, if your employment was terminated or you change jobs, then the default is it's an employee or an individual responsibility to pay out that loan. So it's at the end of the day, from a bank's serviceability calculation, it's still they'll still factor that into their calculations whether you can afford to buy that home or
refinance or whatever
and
it
stuff
might be.
like that. So it's just something to watch that people sometimes think, oh yeah, it's just for my employer. From a bank serviceability, it's still take into account for your personal stuff.
Yeah, and that's I guess where the financial literacy comes in. It's knowing what levers and pulleys affect other things down the track. Another question that comes to mind is just with the whole rush on electric vehicles. You mentioned the cut-off date for the hybrids.
Yeah.
So if I was in a agreement currently with a hybrid vehicle, or if I was about to enter one, does that mean that my terms are going to change in April, or do I get locked in for, I can't get grandfathered in?
Grandfathered in. So what we mean by that is that the rules change only for new purchases from 1st of April this year. So if there's basically you've got the vehicle now, or will have by the end of March, then you're locked into the FBT exemption. So that's an important point there.
Yep. So we've kind of covered off on salary packaging in terms of vehicles, potentially meal allowances, mortgages. Certainly as a financial planner, something that I like to deal with is superannuation and salary packaging there. Again, we use the word salary sacrifice kind of interchangeably with that. Really we're talking about pre-tax contributions into superannuation. Yeah,
and just a point to clarify, superannuation, both from an employer perspective, is fringe benefits tax exempt. So if your employer put in extra out of their own pocket, or if you're working for yourself and you put in extra, or you do a salary sacrifice, it's all fringe benefits tax exempt. So, which is an upside that sort of the government allow for people to put extra money into super through that arrangement.
Purely being because I suppose from their perspective, the higher people's super balances, the less likely they're going to be to rely on government services in retirement. So things like the age pension, they can almost self-fund at least for a period, if not the full time. So I thought it might be valuable to actually talk about the impact, or like the positive impact that contributions into superannuation can have for those who are in a cash flow position to afford that, and just to discuss some of the key trade-offs, because there's always upsides and downsides to things, so good to be fully informed.
So just to clarify, we're talking about salary sacrificing or a once-off contribution.
Yep.
Same effect in a superannuation context and tax, but there's sort of a cash flow
That's a good point. Yeah, so both are designed to reduce your taxable income at the end of the financial year. From a cash flow perspective, some people elect to have that done on a fortnightly basis or just in line with their pay cycle. But there is now the provision that you can effectively put a lump sum in prior to the end of the financial year if you need to top up the amounts. Important that they go in pre-tax, and the wording that they actually use is concessional.
Yep.
So the way that I keep that straight in my head, because there's lots of words and lingo thrown around with pre-tax, post-tax, concessional, non-concessional, is when else in your life have you heard concession be thrown around? Sometimes it's when you, I guess, go to a cinema or you're catching a bus, that they'll say, are you eligible for any concessions? They're asking, are you eligible for a discount? And a concessional contribution is a discount on tax payable. So contributions into super get taxed at 15%. And so if outside superannuation you're being taxed at 32 cents in the dollar, you're effectively swapping those tax rates around. The downside being that you're locking or preserving those funds until retirement. So that's the key there. So thought I'd
go through an example.
Yeah, so I've got a bit of a case study. It's a shame we can't share the screens, but I've got it up here. So we thought we'd just use an average income of say $70,000 a year. Assuming this person's running a budget planner and they've got a little bit of surplus, they're now thinking, what do I do with this money? Should I start to build my wealth for retirement later on, and what's that impact to me now? So for the average person earning $70,000 a year, if you were to start doing $100 a week, which is achievable for most households, you think it's probably a carton of beer and a few other things that you can tend to scrape together $100. So it equates to $5,200 a year that goes into superannuation. What you're effectively doing is you're reducing your take-home pay because of that. Again, salary sacrifice, you're sacrificing your salary. And that contribution that goes into superannuation still gets taxed at 15%. So that is worth knowing. It's not just purely moving it from your personal name into superannuation and the government doesn't get any. They still tax you at 15%, which is more attractive than your tax rate when you're earning $70,000 a year. Someone might actually look at that and go, yeah, but $100 a week's not going to change anything. So we always like to project, well, what's the long-term impact of that? Because 20 years of doing contributions plus you know, the compounding of investment returns, the tax savings along the way can have a really big impact. And so done a bit of projection. So if you had $100,000 as your super balance, you're earning $70,000 a year as an employee, they're paying the 11.5% superannuation. Projected out over 20 years, it actually looks at, what have we got? Just checking the total super balance after the first year. So you've got 100,000 plus 7% growth is 107, plus your contribution gets you to 111,000. Now I know this is probably difficult to track because we've got it on screen here, so it's probably easier if we follow it. We might even do that in a separate
so you can
podcast.
probably, I suppose what you're saying is you're putting that, it's a compounding effect of making the contributions on a regular basis now, and compounding that over
long term. So
long term.
We had over 20 years. If you weren't making contributions, you were just doing your standard returns, your super balance would be around 293,000, which for an average super balance for someone retiring, probably a little bit on the lower side, but still good that they've got the savings. By just shifting that $100 a week, the super balance would actually grow to 434,000. So straight away, you're talking $140,000 difference, plus you've saved, I think I've got there, it's a bit over $30,000 in income tax along the way, just for that $100 a week.
So the savings in income tax, so pretty much the maths in that scenario, just to sort of re-emphasise, in this example, your marginal tax rate of 30% plus 2% Medicare, so 32% tax saving. So it's an important point to note that by the salary sacrifice, you're getting that tax saving. If you're doing it on a fortnightly pay-by-pay cycle, you don't get a lump sum tax refund because you've had that benefit in your net pay adjustment each pay run, versus if you did a lump sum payment at the end of the year, additional money to super, you get a big hefty refund check. But I think the principle is still strong that you doing that on a regular basis, so from a budgeting perspective, as well as the whole principle of compounding interest, that you're getting a return on that money throughout the year rather than a lump sum at the end of just before the end of the financial year.
Yeah, it's a good point, and there's both ways you can do it. So from a managing your finances perspective, it can make sense to do the salary sacrifice on a fortnightly basis with your pay, because you just don't see it and it happens in the background. For some others, depending on how savvy you are, they may say, no, I prefer that money to build up in my offset account, offsetting interest for the year on my loan, and then I'll put a lump sum into superannuation before June 30, claim that tax deduction, and then get the lump sum tax return that can then be used for next year. So it depends on what's going to work better for you. It's really around your personal circumstances, but certainly just looking at, for someone who's earning that $70,000 a year, putting the $100 away, it's about $1,500 a year that you're going to save in income tax.
So it's a very tax effective strategy, and as you mentioned, obviously the downside is that you've got that money locked away for your retirement. So it's an attractive carrot, bearing that in mind, and that's what what you do in your day-to-day job, help people navigate what works best in their personal circumstances. That versus paying down mortgages and all that sort of scenario planning you do with your clients. Yeah,
and that would be a good one to probably jump into at a different podcast session, I think, because that's often a common question as well, is do I pay off my mortgage or do I start contributing to super? So we can run through that. But I think it was a good session today. So learning a bit more about vehicles and things you can salary package. So certainly if you're unsure of how your existing agreement works or whether something is appropriate for you, best to reach out to an accountant or a financial planner to get tailored personal financial advice.
Yeah, I think just to summarise, so packaging, if your employer offers that, that's certainly worth exploring, especially if you're in the not-for-profit government space and they do offer that option. So take that away. If you're in the private space and your employer offers it, look at that for your vehicles. Ongoing electric vehicles does have the FBT exemption, so certainly worth considering. Go through it with your eyes open in terms of a novated lease, because there's great benefits, but some hidden traps depending if you think you might change employers in the next 6 years. It might be worth considering that. And then, as Josh pointed out, and we'll probably do as he indicated, a follow-up session of, from a tax perspective, having that contribution in a salary sacrifice arrangement is a great tax planning benefit. But compare that to your cash flow needs at the time, and worth taking into account. So thanks.
Yeah, appreciate your time this morning. It's good education for me.
No
And
worries, Josh.
I guess we'll see you all at the next one.